Welcome to the weekly update, where we'll go over the action in the market for October 3rd through the 7th, and then see how things look for the week of October 10th through the 14th. And we had a good start to the week, had a really good start with some massive up days on Monday and Tuesday. Wednesday was kind of meh, but then Thursday and Friday, we fed back into this negative idea because the market had been developing again for the fifth time in 2022, the idea that maybe inflation has topped, it'll start coming down, and the Fed might become more market friendly. Well, that was quickly dashed on Friday when the employment report came out, and it was stronger than expected, mainly in the headline numbers. The other numbers that come out with that report were pretty much in line with what was expected, although the unemployment rate did drop down to 3.5%. So it's just another one of those things where the market is trying to anticipate what is happening going forward. They find some way to rationalize this idea. It goes up a little bit and things look to be improving, only to have it dashed either when we hit resistance or when there's a speech that comes out or economic report comes out that was much stronger than expected. And so we tend to turn and go down with a vengeance. There are some positive things happening right now. There are also negative things, and I'll go through the charts here. So let's go back and talk about the week. Monday and Tuesday had strong up days. Now, this was the beginning not only of the week, but the month and the quarter, the fourth quarter. So you have a lot of new cash being deployed at that time, and that gave some support to stock prices. The market, again, bought into this idea that the Fed would just taper off a little bit with their interest rate climb and maybe turn a little bit more dovish, especially on Monday when we had the weaker than expected ISM manufacturing that came out. We also had construction spending, and those were both weaker than the market had been anticipating. So they thought, aha, here we go. We're going to start to see interest rates either level off, or if not, at some point in the future, start to come down. Because remember, the stock market is always looking forward. It doesn't look backward. It tries to look forward. Another thing that helped to play into the scenario was the Bank of Australia. They raised their rates, but it had been expected that they would raise them by 0.5%. They ended up raising them 0.25%. So again, folks said, maybe this can feed over into what the Fed is doing. But then Friday was negative after having a negative Thursday, when the employment situation report did come out, and it was stronger than expected in the number of new jobs, both private and non-private jobs was quite a bit more than the market had thought. As this has been developing, interest rates are going back up, so they're rising, and the dollar, which had seen some weakness, the stocks were going up. Well, as stocks were going down, the dollar is going back up, and that's giving a lot of pressure to stocks. But still, even with the wild swings that we saw during the week, the S&P was still up 1.5%. And there's nothing really that we're getting from the Fed that I could find anyway to suggest that the Fed is willing to pivot. Now, they may at some point, but we're not getting anything like that. There was one report about a week ago out of CNBC Europe where somebody on the FOMC said maybe we're raising rates too fast, too quick, because the markets haven't really had a chance to see what happens as these rates work their way through the economy. They're rising, the rates are rising so quickly that there's some lag time before we see how this can influence things. But other than that, all of the people on the Fed, they're still saying, no, inflation's number one. We're going to keep raising interest rates. Once we get them to a point where we think things are under control, we're going to keep them at that point for a while. The Atlanta Fed President Bostic said that the inflation fight is still in the early days. And then you had the Minneapolis Fed president come out, also a voter, and said that he's not comfortable with pausing until there's an evidence of inflation that's actually cooling. Well, the market could already say, wait a minute, look at CPI. It is, yeah, it's not really going down as much as we thought, but it is right now looking like it topped out, which is interesting because this coming week we're going to get another CPI report. So that could be a real pivotal event that happens to help determine the direction of the market. And then OPEC, on top of that, announced that they're going to cut production of 2 million barrels per day. This will be starting in November, and that's starting to drive oil prices back up because there's less oil out there. And we're already seeing very high prices. We've got an election that's coming up. The politicians don't really like this. Some people are saying OPEC might be doing this just to spite America, where others are saying no, there are some issues going on within OPEC, and they're not able to produce as much as they were before. So, and even with doing a cut of 2 million barrels per day, they're still not up to what they should be. And again, it can go back and forth, but the bottom line is production is going down, and that will push oil prices up. All right, so for the week, we were up 1.51%. Volume has been about average. The down days, which can be a little bit encouraging, we were right at average volume. Where the up days, we saw pretty healthy volume. The technicals, they're negative overall, but there's also, we're starting to see some extreme negative readings. We're seeing some of them in our daily charts. And then with the big up days, those started to work off a bit. Well, now with the down days, they're becoming more extreme negative again. But we're also seeing some extreme negative readings in our weekly charts. And we're kind of seeing a convergence coming together. Now, we're also coming into a more favorable season for the stock market. Usually going through October, it can be crazy. It can be up times, down times. And the market will possibly be more optimistic once the election gets over as well, because people are more optimistic. There's new people coming in to do things, or the people that they like stay in office, and people will just be glad to have this behind them. But the big fixation continues to be inflation and interest rates, but there's a whole list of geopolitical concerns that could always come to the surface and always take over and have an influence on the market. Our trend, it's because we're kind of going down a little bit more than we're going up, even in the weekly charts. It's starting to strengthen. The ADX is turning back up, and it's a negative trend because the red line's on top, and I'll show you a chart of that. So here's the intraday chart. Over here on Monday, we had a really strong move up on Monday, and we closed just a little bit off the highs. Then on Tuesday, we gapped a lot higher, and then we're able to hold on to those gains and close pretty much at the high. Wednesday, even though we opened down, there was a pretty impressive comeback in that day. And we closed off of the high, but to be down, I think we were down 1.8% at one point, and then to rally back up off of that was pretty impressive. Even though it was a down day, we were pretty much flat on Thursday, in ahead of the employment situation report. Then on Friday, when the report came out, we gapped below S1, S2, and this should be S3 down here, and we saw a lot of selling going into Friday's session and then closing out the week. So for the week, the Dow was down 2%, the NASDAQ down 0.7%, the S&P was down 1.5%. I also have it as 1.51%. And the small caps, led by the Russell 2000, were down 2.2%. But the small caps are holding up a little bit better. The mid caps are still hanging in there as well. So here is just looking back over the last 5 days, the small caps were actually up. If you go from Monday to Friday session instead of Friday to Friday, and the mid caps, they were down, but not very much. And the NASDAQ, it was down a little over 1% if you just count the 5 trading days last week. And then this is going back to the all-time high. How have these different indexes performed? The pink one here is the S&P. That's what I use to compare things to. But the Dow, the NYSE, mid caps and small caps, they're actually doing a little bit better than the S&P, where we still have the Nasdaq and the Nasdaq 100 being down the most. Because if we get to the point where things turn and start to go up, we'll probably be led by the Nasdaq and the Nasdaq 100 because this is more growth. Looking at our sectors on the week, energy did the best. After having some weakness in the recent past, it really came back. It was up 13.58% for the week, followed by industrial materials. Communication actually was up slightly. We had staples going down, discretionary going down, utilities, which have just really gone out of favor. It seems like they were holding up until just recently as well. And real estate has really been starting to show some downward movement in that sector. And this is just looking over the last 5 trading days where energy did the best. And then all the other sectors were down, but real estate and utilities really led the way lower. Looking at our current market valuation updates, we're still fairly valued right now. Here's the aggregate score. This is taking all of their charts together, where we're still coming down off of the yellow line, which that would consider to be overvalued, but we're still above the dash line. That's the point between positive and negative. So we're still taking all of these charts together, considered to be fairly valued. Here's the yield curve, which is also fairly valued. It's still below the yellow line of 1 standard deviation when you compare it to the historical average. The Buffett indicator has also been coming down as stocks have been coming down. That is considered to be fairly valued when compared to the historical trend line. The PE model that we're looking at is also coming down as well. And the interest rate model is also dropping a little bit below zero here when you take into account that interest rates are still pretty historically low, even though they're going up right now. The margin debt model, that was revised at the end of August. It's also coming down, and I have another chart to show you, I believe right here, where we're seeing kind of an extreme negative reading with margin right now. This is not price. This is a monthly chart of margin debt. And sometimes this can mark a bottom in the market because that means that not a lot of margin is being used right now. If we turn around and really start to head up and get some legs behind an upward movement that lasts more than a couple of days, or that can break through some overhead resistance, you'll probably see this line go back up because people, they want to get better returns on what they do. So a lot of times they'll end up buying on margin. Then looking at our mean reversion model, we're also coming back down to a more fairly valued reading currently. Sentiment as of Friday's session, we're back over into extreme fear. We're below 25. Currently, how we had come up out of that earlier in the week, as we were going up, fear was subsiding. Well, with specifically Thursday and Friday, the fear started coming back down. This is about a week old now, but the active asset managers, after giving an extreme negative reading, they did show some recovery. But this doesn't really take into account the big days we had early in the week and the down days we had later in the week, because there's a lag time here. The Ridex Bull Bear ratio, or Bear Bull ratio, this also is a little bit lagging here because as we were going down, people were getting into the bearish mutual funds, and the investors that use these vehicles, because they have jobs, because they're busy, they don't really watch the market all the time, they tend to have the habit of reacting to what's already happened. So we had the big down day a week ago, and that's when people started piling into the bearish funds. Well, then we had the big up days on Monday and Tuesday, and so now they started getting out of that. So they have a tendency to be a little bit late, but we did get to kind of an extreme negative reading. Just look at this like you do the VIX. When it really goes up, that means they're really in the bearish funds. Well, when we're going down, when we're going up with the market, this has a tendency to come down. So we use this as a contrary indicator at extreme readings. We also had the latest reading of American Association for Individual Investors. They're also still extremely pessimistic, which a lot of times we use this as a contrary indicator. When it's in the middle, we kind of go with what this is doing, but we keep trying to bounce up out of here, and then things look a little bit better, then they come back down and we end up giving an extreme reading again. We're seeing a little bit of an improvement with the GDP forecast, where it had been down to 0.3, still positive, but just barely. Well, they revised that, and now we're at 2.89, or you could say 2.9. So according to this GDP Now model, they're still forecasting that we will have positive GDP for the third quarter. Then we're still not really seeing any danger yet with the spread between the risky bonds and the not as risky bonds. It's actually coming down a little bit. But this next chart, we're starting to come up. We're still under the black line. This is the financial conditions index. Where we start to get nervous is if this breaks above this black line. And we're going up and we're close to that, but we have not been able to get above that yet. Then looking at some Isabel net charts, this just shows the biggest inflow to cash since April of 2020, which of course that was right in the middle of the pandemic and the lockdowns and everything else. So we're just seeing a lot of people are going into cash, and even the moving average is really starting to go up. People don't know what to do. And we've been in a really bouncy, very challenging environment for 2022. We get to the point where it looks like we bottomed and start heading up, which is what most investors do. Something happens, we hit resistance, or an economic report comes out, and that seems to change everything. And so people are just kind of sitting back going, okay, I'm just going to be on the sidelines. Now, if we do get some kind of a sustained rally at some point, this cash in here could really be put to use, and that could give some support to stock prices. The insider transaction ratio, we're actually seeing this ticking up a little bit into the bearish area. So you might be able to say, was this because it was the beginning of the quarter? Possibly. Or are people that really believe in their companies buying stock because their price is going down and they're getting it at a better price? Then this just looks at within the context of a bear market. And there's still the debate going back and forth. Are we in a secular bear market, a secular bull market? We're going up and we're going down. Okay, that's kind of where I come out. But to debate things back and forth, it's like, okay, let's talk about other things that matter a little bit more. I know that's where I come from. I know some money managers and people that invest and trade, they have to look at that a little bit differently. But I often say that we'll see some of our biggest up moves during bear markets when we're going down. We'll see some of our biggest declines during bull markets. Well, going back to 2007 into 2009, we were in an overall downtrend. But within that downtrend, we saw some pretty powerful moves back up, 11%, 7%, 12%, 7%, up 24%. So this is what I do in my program, is to try to take advantage of these things. Okay, we know that we're in an overall downtrend, so we're situated for that with some of our longer term strategies that we implement. But there's nothing to say we can't take advantage of some of these up moves along the way. So you might even have a mix and match in some of your portfolio where you're long, hoping the market will go up in one way, but you might take advantage of some downward movement or add to your upward movement during those times. And that's why I look at the short, intermediate, and long term for all the different strategies that I teach. Here's another one. This is looking at temporary help services, and it's at 11.3, which a lot of times, if we're heading into a recession, we would want to see this red line really drop down, where we did back in the early 2000s during the great financial crisis and during the COVID plunge. This still is holding up. And this is what's giving a lot of hope to the economy, that the employment situation is still doing okay. It's also giving justification for the Fed to continue raising interest rates. Until we see the unemployment rate go up, and people starting to lose their jobs, it's probably going to be difficult based on where we stand right now. It'll be difficult for the Fed to actually turn and pivot. And the central bank, a lot of these banks all over the world, here's Russia and then the rest of the world, excluding Russia, they're buying a lot of gold. Now, gold has really been having problems if you're a trend-based investor or trader in gold. Everybody keeps saying this is it, it's going to happen, we're going to the moon with gold, only to have prices fall back. But this is just showing how the central banks are really increasing their purchases of gold, which could ultimately add some support to gold prices. And then this is the US GDP and the current activity indicator. This is what we're seeing right now, this black line, as far as the current activity, and it's still going up just a little bit. Then we look at this blue line here, and this is the historical GDP, which has been declining, and they still think it'll be positive in 2022, but then they're seeing it still positive but declining going into 2023. That's just the estimate right now. Then JP Morgan, they think that inflation has topped out and has been starting to come back down. They think inflation is going to continue to decline. From here, here's some FactSet blog posts here where it says more companies, more S&P companies issuing positive earnings per share guidance for the third quarter compared to the last two quarters. And I highlighted this yellow part here because they're still pretty negative overall. That's the red bar going up here. But you see the green where it is showing some increasing as we're going forward from right now. So that means they're giving positive guidance, saying that, okay, we can raise our earnings per share that we thought we were going to get. We can even increase that a little bit, and that could be positive for the markets. And another blog post says that 50% of S&P 500 companies, they're citing a negative impact from foreign exchange. The dollar is still holding up, and that's messing up a lot of countries right now when they convert that. And it's messing up a lot of US companies too, because I think in the S&P, about 40% of S&P companies do business internationally. So when they convert that money over, with the dollar so strong, it makes it look like they have less money. And this just shows the number of companies where it was 2, 3, 6, 7. Right now, 10 out of this are just saying that, this strong dollar is really kind of it's starting to mess us up a little bit here. Looking at the VIX, it did go up a little bit. We're getting kind of extreme on the weekly chart right here. Even though it declined a little bit on the week, it's still giving us kind of an extreme reading, but it could still go higher than this. That's what a lot of folks are waiting for right now. If we're going to hit some kind of a bottom, have we really seen a true capitulation yet, where everybody just says, I don't want to own stocks at all. I've lost money. This is very frustrating. I bought it on margin and I have to pay that money back, so I have to sell. You get to the point where nobody wants anything to do with the stock market again. That's when you start buying, because it goes completely opposite to what your emotions tell you. And that's what the smart money does. They're buying as things are going down and looking really negative. And we're in a really negative environment right now with a lot of geopolitical concerns, with any one of those blowing up at any time. So that's putting a lot of pressure on stocks. But have we really come to that critical mass point where we really truly get washed out? It doesn't seem to have happened yet. It's happened more on a short-term basis and even a little bit on an intermediate term basis, but long-term, we haven't seen that big washout, at least up till this point. Then the Ulcer Index, as we've been going down overall, this is starting to really go back up. This measures fear in the market. And then the possible positive scenarios, if you want to keep up with those, I update those charts every day in the daily video that I do. They were looking pretty good after Tuesday, and it looked like we could really build up off of something. But then Thursday and Friday came along, and it's kind of taken those off the table for the time being. But they're still there, and they're still viable, and there's still many of them coming together at the same time, which often produces a significant base for which the market to go higher. But until we see follow through with price, we can't go with that. And my personal stance is I'm not going to stand in front of a freight train. I'm not going to try to catch a falling knife. We see what could be happening as far as these setups, but until we see price start to confirm that, I don't jump in until we get through that process. Because one of the things that really gets me is you go to these seminars and seem like for 2020 and a lot of 2021, it was buy the dips, buy the dips, buy the dips. Well, I don't really like that. People are they're gambling at that point because they're like, okay, I got this at 20, it's dropped down to 15. I just got a hunch that it's going to go higher from here. And sometimes that works and sometimes it doesn't. I want to see confirmation with our charts before I say, okay, it's time to add more to this position or to jump into a certain position. But that's me. I tend to be just a lot more conservative overall. Let's look at some earnings and valuation. On a historical basis, we're still expensive. The current PE ratio, looking back, is 27.24. Looking at the Shiller PE ratio, where the median and the mean is between 16 and 17. So historically, we are expensive still, but this is the next 12 months or NTM when you take in, and that's what the market uses, where you take the earnings per share forecasts and develop a forward-looking PE ratio. And right now we're right down around the 16 area, which is more fairly valued. 15 would be right at fairly valued. 20 is considered expensive. We get down to 10, it's considered inexpensive. So we're right about in the middle looking at this chart. Now this changes slightly every day as new reports for earnings come out and stock prices go up and down. But when this chart was created, we were at a pretty neutral place looking forward. As far as the Fed watch, we were at about 40, between 40 and 50% before Friday, as far as how far is the Fed going to raise interest rates at their next meeting on November 2nd. Well, when the employment situation report came out and it was strong, boom, we shot up to 81.1%. Now, this changes every day. We might get some people that don't buy into this as much if some of our economic reports going forward are more market friendly. But right now, it's pretty high probability that they're going to go with their 0.75% increase at the next meeting. We are seeing the Fed balance sheet start to decline as some of the bonds that they bought to add liquidity to the economy as they're basically expiring or maturing, and they're just not replenishing those. And then another way to look at this is central bank liquidity. That's the dark blue line, and it's been really coming down. This is how Apple, Amazon, Meta, Google, Microsoft, Netflix, Tesla, they've been really going down too, because a lot of the support, especially after the COVID plunge, all that stimulus that was thrown into the market, that gave huge support for stocks. Well, that's starting to come out of the system now. And so that's one of the reasons we're seeing prices really decline. Looking at breadth, we had a pretty negative reading overall. So based on price and volume, we're not showing really any improvement there yet. Our advanced decline ratio starting to get extreme negative with our 19-period exponential moving average. New highs, new lows also, even though there were contracted a little bit with the new lows, we're still in a pretty solid downtrend. If we look back 4 weeks, even though it turned up, and we're turning up slightly if we go back 10 weeks, but this will need to improve. We want to see a lot of green up here if prices do in fact go up to help give some internal strength to the S&P 500. Accumulation distribution is still looking more negative on the weekly chart. Looking at our trend, this is what I'm talking about with the ADX. It is turning back up and getting a little bit stronger. It's slightly above the moving average. The red line, even though it declined, it's still on top. So we have to go with the idea that on the weekly chart, the S&P is in a down trend that could be getting stronger. The Arun didn't really change all that much. It still shows that sellers are in control because that's pegged to the top, where buyers are not really having that much of an influence. We saw a little bit of a tick up, but when you compare the red line and the green line, we're still getting down to a negative reading, but this is pretty extreme. You could almost use this as some kind of overbought, oversold indicator when it gets down to be this far, because at other times when we've had really, really negative readings like this, that sometimes suggests that there's exhaustion in the selling. But if you look during the COVID plunge, we never did really go extreme with this. The last time was back in 2016. The mass index not helping us now. I had developed a scenario in the daily video that the mass index was part of it, but that didn't really seem to pan out. It might have if we saw some follow through after Monday and Tuesday's gains, but since that didn't happen, that chart is not helping us, and we're far away from generating a signal with this chart on the weekly version. Here's a daily look where we're still holding above this long-term support here. This was the June low. We came down and actually broke a little bit below that, but we closed right on this line. Now, I draw these lines myself, so they're not necessarily exact science, but so far this support level, even though we come down to it on an intraday basis, it is holding up on a closing basis. Can we bounce up off of this? Another thing that's kind of negative in this chart, see these three bars? This was Monday, Tuesday, and then Wednesday. And then we had a big bar going down. This is called an island reversal, which is actually quite negative. We shot up and it looked like, okay, everybody, it's party time, but then we just broke right down after that. So we want to keep an eye on that. That is not a positive looking chart. Doesn't mean it has to stay that way, but right now it's just not looking very good. Then if you look at the bottom, we are above average as far as volume. We're just a little bit below the midpoint of the trend channel, going all the way back to 2009 lows here. We've been able to come down below that before and then show some recovery. Will that happen this time, or will we eventually fall through and go to the other side? The pivot points right here for the month. I don't post this on the YouTube channel. I do post the pivot points that are good for the month, and I post the pivot points that are the intraday pivot points. And if you go to the YouTube channel, my YouTube channel, and click on the community tab, I update those two charts that you might find helpful. I don't post this one right here. We're still below S1. We tried to come back up a little bit, but we're kind of in between S1 and S2 right now with our pivot points. We're below the 50-period simple moving average. It's going to take a while to get that back. Our long-term trend continues to be down. The bullish percent index also gave us kind of an extreme negative reading, even though it could go lower. The last time it went lower than this was during the COVID plunge, but we're bouncing back up out of that. If we could see this regain some strength, that would be more positive for things. Chaikin oscillator long-term, we're getting extreme negative on this. So the nice run up that we saw that didn't seem to last all that long, that ran up last spring, we had that kind of a run up after getting an extreme negative reading. And then this is a positive divergence where the Chaikin oscillator came down, set a new low, went back up, came down, set a higher low, and then boom, we were able to get some support going into the market after that. Will something like that happen again this time? Chaikin money flows also showing some weakness right now. We're below zero and declining. The force index, even though it's under zero, so it's red, it did turn up slightly in the past week. McClellan oscillator, it is negative right now, even though it did show some improvement. The summation index, this is a longer term indicator. we're starting to get extreme negative based on price, and we're already extreme negative based on volume and bouncing up just a little bit. And sometimes with this chart, volume can lead the way, can be like a leading indicator. Then as far as our oscillators, the slope is down, the MACD, the KST, which had crossed over positive, is now starting to roll back over. The tricks and the PMO and the TSI, they are still pointed down. So that is negative overall. The Swinland Trading Oscillator, after getting extreme negative based on price and volume, we're starting to see a bounce back up, and this could be positive. We're actually above the zero line on both charts. Here's the negative PMO that I talked about. We're also getting extreme negative based on price, not quite extreme based on volume. But see how we're becoming oversold on the weekly charts. And that could be a more powerful condition for the market to go up. And then looking at the percent of PMOs that are rising after getting extreme negative is showing some improvement. The buy signals are showing improvement after being extreme negative. We're trying to turn back up with the PMOs that are above zero. Is this enough? Are these extreme negative readings that we're seeing right now, is that capitulation enough? Or do we need to see more of a panic washout type of situation? That's kind of what I'm going with right now. RSI, even though it's below the 50 level, it did turn up slightly in the past week. Special K, this is a long-term trend measurement. It's, even though it's weakening, continues to be positive. Stochh RSI, extreme negative and bouncing. Williams percent R, extreme negative and trying to bounce. The Vortex continues to be negative, even though it declined with the red line. The green line is below, so we're negative overall. Ultimate Oscillator, kind of flat, but still declining. This would be more negative. Money Flow Indicator, it was flat to trying to turn up slightly, so that could be a little bit of an improvement there. The Bollinger Bands percent B are not giving us an extreme negative reading, but they did turn back up slightly. The KST, which had crossed over positive back in August, it's not seeing any follow through here. So it is starting, it's still positive, but it's starting to show some weakness. The PPO, which had crossed over positive, has now crossed back over negative and is declining. So that's negative. The rate of change going back 1 week shows a little bit of improvement. We're getting to the extreme here with going back 50 weeks, which is roughly a year, where we're coming down to the COVID lows again here. So this might be part of the extreme oversold condition that we're seeing in some of our longer term charts. Copic curve, we do have a signal on the daily charts where when this crosses and then starts to go up, that will give some support. Doesn't tell us the direction. It just says something big might happen, not whether it's up or down. We don't have a signal being generated right now on the weekly chart, but we do have a signal on the daily chart. This was pretty important. We closed right down to the 200-week moving average, and then we're able to bounce up off of that. Well, we're coming slightly getting back down to the closer end of this. Will this 200-week support level still hold? And that's at about 35.94-ish or so. Can we stay above that level? If we break below this, then we have more support below us, but that would turn things a lot more negative. Looking at our charts, the Heiken Ashi continues to be negative with the solid dark candles. The Kegi is still positive. I'm sorry, it's still negative, but the red line is going up slightly. The Renko continues to be negative. Ease of movement, it's pretty much flat overall, even though it showed some improvement going back 1 week. Point and figure, we had some new X's drawn in here. There's no pattern, no signal that's been generated, but anytime you see X's in a point and figure chart, that's positive, as zeros are negative. 3-line break is also looking more negative. With our elder impulse, we are still negative. Parabolic SAR, the dots are still on top, so that is also negative. Broad market, here's the S&P, which is coming down and making a new 52-week low. The mid caps, they're holding up a little better. And with our technical analysis scores that I look at every day, the mid caps have consistently been in first place. Nothing great, but doing better than some of the other indexes like the S&P, the small caps, the NASDAQ, and the Dow. Or the small caps, they did go down and have recently set a new 52-week low. All stocks still in a pretty solid downtrend overall, even though we saw a bit of a bounce. Mid caps, see how we haven't really broken down, at least on an intraday basis, to make a new low. Now that could change at any time. And the mid caps are still in an overall downtrend, but so far this index has been holding up better than the other ones, where the small caps are also in a downtrend. The Dow continues to be in a downtrend. The NASDAQ also could be setting some kind of a double bottom here. If we break below that, that could be much more negative. If we go back up, that could provide some support. And we're seeing pretty much the same thing with the NASDAQ 100 right now. The Wilshire also could be putting in some kind of a double bottom, but still negative overall. The NYSE, it's breaking down a little bit more. FANG stocks also have not necessarily broken through to a new low. They have on a closing basis, but I'm looking at the intraday bar here. So this so far is holding up. ARC also, even though it's just been getting decimated for 2022, is still seems to be holding up. We're not seeing it break down, at least yet. The software companies also seem to be holding up a little bit better currently. Looking at Dow theory, where the Dow has been coming down, the trannies have been coming down. Utilities were like up here not very long ago, and they've really been coming down and are setting new 52-week lows. They're just getting hammered right now. The Crb Index, after coming down and potentially seeing a death cross, we saw some bounce back up. Now, this was due to some earlier in the week dollar weakness. And if the dollar is going up, that can hurt certain commodity prices since they're denominated in dollars. This gave some support. We're still in an overall uptrend, but we're seeing the Crb index overall showing some weakness. And then looking at copper, we kind of fell down and we've been right in this midpoint range pretty much since then. Gold, which had really come down, and then it looked like it was going to possibly break out. Well, it gave a lot of those gains back currently, and it's still in an overall downtrend. Same thing with silver. It looked like it was going to break out, and this could be kind of negative, where you have the open and the close right about at the same point at the low, near the low of the bar. But silver continues to be in a downtrend. Oil has been going back up. We're at 92.64. Here's a weekly chart of the dollar. Even though we saw some weakness here, it just continues to hold up. Not because the dollar is anything special other than being the main currency of the world, but it's just because all the other currencies are even worse. So it's like, what are you going to do? Well, let's go into the dollar. At least that might hold up a little bit better. Looking at bonds, we continue to be in a downtrend based on price as interest rates continue to go up. This is a daily chart, and look at, this is the blue line. That's the 2-year yield. That's where folks are getting the highest yield right now, is in the 2-year, where you've got the 5 and the 10 and the 30 even below that currently. Internationally, showing how, see how the black line here, that's the UK. They've actually shot up more with their 10-year yield, where the green is the US and Germany is the blue, where Japan is still pretty much going sideways. They're having their own issues in Japan, which are a little bit different than what the rest of the world is dealing with right now. They're still trying to stimulate their economy and have been trying to do that for a very long time, where it's like the rest of the world, the economy is overstimulated with all of the stimulus that was added. Intermarket analysis, oil had a pretty good week and is still in the lead, followed by the dollar, where we have gold, stocks, and bonds being down going back to the beginning of the year. Saw a little bit of a decrease on the bonds to stock ratio with the shorter maturities, where if you look at the stock to bond ratio, just the inverse of that, it's showing how stocks, even though they've been suffering, have been really outperforming bonds. And this has been frustrating for a lot of folks. When the markets hit difficult times, what do? You get out of the stock market, throw it into the bond market, and maybe the bond market will hold up a little bit better and at least give you some kind of a return instead of getting losses in the stock market. That's called a risk off type of setup. Then when you get back into stocks because you want capital gains, that's a risk on. Well, nothing has worked other than the dollar and oil. That's been about the only positive thing in 2022. Then gold to the dollar, where gold has been going up, we saw a little bit of dollar weakness, but this ratio is still really, really weak. Gold is really underperforming the dollar. Where gold to the S&P, gold has really been suffering, as I said, but the S&P has been suffering more. So gold is still having a tendency to outperform the S&P. Low volatility stocks. This is another area that folks get into when times get pretty difficult. Still in an overall uptrend, but saw some recent weakness when compared to the S&P. Growth, which this is where you get your capital gains from. Value, this is what you hold on to for longer term, stocks that tend to hold up better. Growth has been really underperforming value. We saw a little bit of hope, but that has now been dashed. NASDAQ 100, also growth based compared to the S&P 500, which is growth and value. It just shows how the NASDAQ 100 has been underperforming the S&P. The S&P 100, the biggest companies in the S&P 500, they've been really underperforming and setting a new 52-week low here on a ratio basis when compared to the S&P. Discretionary has also been in a continued downtrend. Energy has been going up, especially when you compare it to tech, which has been going down. So then what's our outlook for the upcoming week? On Tuesday, we don't have any reports coming out on Monday, but Tuesday, we have the NFIB Small Business Optimism. That'll be coming out. Wednesday, this is kind of a big one. We have PPI coming out, the Producer Price Index. And then we've got the biggie on Thursday, CPI, Consumer Price Index. This is the official inflation report. And the markets are going to be really anticipating that report coming out in addition to jobless claims. Then on Friday, we have another big report, retail sales, because retail consumers make up such a huge part of the U.S. economy. And we'll get the preliminary reading of the University of Michigan's consumer sentiment. So we're watching the technicals. You can see how, yeah, we're negative. Can't really doubt that. Showing some improvement in some areas. And we're also extreme negative in some other areas. So you could make a case that we could get some support and go up from here. But all of our trends continue to be down right now because of inflation and interest rates and this whole game that's being played right now. We might get some Fed speak this coming week that could influence the markets. What would really help the market is if they hint of a pivot, especially from Chairperson Powell. Now, if it comes from anybody else, yeah, it's kind of cool and everything, but he is the person that we need to really look to for making a statement. Could also come out and just reiterate what he's already been saying, that we're going to fight inflation, and we don't really see lessening on our interest rate rise policy, our current monetary policy, or that we're doing right now, because there really hasn't been any evidence of that, at least yet. So our scenarios, this is just for Monday session. We're down overall on the daily charts, but we're starting to become oversold. We were oversold a week ago. We worked some of that off, and now with Thursday and Friday's decline, we're back to showing more of an oversold condition on the daily charts, but we still have to go with the down scenario right now because everything's pointed down. We can't really go with the positive things yet because even though there are some potentially positive things that could happen, until we see follow through with price, they haven't happened yet. And we don't want to anticipate that. You can just get clobbered if you try to guess ahead of when you see confirmation from this. At least that's my stance. You could go a little bit sideways because the ADX has fallen below the moving average on the daily chart, but that probably isn't going to last. The red line's still on top. We're negative. We see another down day, and the ADX could turn back up and go above its moving average. So thank you. I hope you found this helpful. I will be posting the intermarket analysis video right after this, and every day I post at least a daily brief And lately, with so much going on, I've been doing full length videos as well. So have a great week, and I'll talk to you next time.